Just a few bad days in the market and everyone's thinking, oh no, was that washed up has-been old guy actually right? And that old guy's response is, F them kids. Buffett told all the kids this is what was gonna happen. All the children asking if Warren Buffett was overhyped, including Kevin here, who's a 3-time Wall Street Bets Investor of the Year. But all our favorite Robin Hood investors talking smack all this time might be a little bit scared now. Now, of course, as I've said before, I've really enjoyed everyone dogging on Buffett. I think it's hilarious. Like calling him an idiot for selling airlines at the bottom. But sure enough, after airlines are dropping almost 30% again, well, they're up a bit today, but people are thinking maybe, he had a point. But it's that short-term thinking that makes markets work. Like, Buffett, what have you done lately? Forget all his decades of experience and all the billions of dollars he made. No. Buffett, what was your last trade? Oh, you sold airlines? You're an idiot. It's the hilarious ignorance that makes markets fun. Now, the best argument that I hear from the people who think Buffett is trash now is that the market will never crash again because of the Federal Reserve. Now, don't get me wrong here. I love Jerry Powell just as much as the next guy and his money printer. But thinking that the market is never going to crash again because of the manipulation from the Fed is just kind of stupid. Because that's not how markets work. So that's what we're going to look at today, and we're going to talk about it using an example of this already happening. Because history just repeats itself over and over, and that includes the stock market. And just to drive the point home, at the end of this video, I got this great old trading commercial. And it's going to prove that there was already a Robinhood way before Robinhood even existed. And it was called Ameritrade. Yeah, you're going to watch that video and realize, oh, you know what? History does repeat itself over and over. And before we get started, if you're looking for a strategy that works on the upside and the downside, regardless of the Federal Reserve, manipulation, or what Buffett is doing, then definitely check out this free training where I show you the strategy that I use and a lot of our Fallible members use too. There's a link in this video and down below in the description and comments. Check it out, it's free, you'll learn a lot. And yes, I finally bought some clippers and just shaved all my hair off. It was getting to be a lot, it didn't even fit under the hat anymore. And I haven't had my hair this short in a long time. When my hair is this short, cops tend to get confused and then they follow me around and they get in my business too much. Which hopefully will be better, after everything that's being done right now. But for my first time cutting my own hair, I don't think it looks too bad. At least the front. The back though? The back is terrible. I'm just glad YouTube is a front-facing platform because on the back is the worst fade you'll ever see in your entire life. But anyway, why can't central banks keep markets up forever? That's the question that we're going to answer, right? Well, if you want an example of it not working, then you don't need to look any further than our friends over in Japan. Which, by the way, have you seen the new PlayStation? It has the most Japanese-looking design. It's these flaring corners right there. That's what gives it away. Every Gundam, Mecha, Neon Genesis thing, same style. But anyway, look at this chart of the Japanese stock market. Look how it absolutely collapsed in the late 80s. It collapsed so hard and has yet to recover to the highs that it once saw. And this is despite all the central bank manipulation they could throw at it. So what happened to cause this? Well, of course, there was an asset bubble. And this is back in the 80s, and you see this absolute massive run that the stock market went on. It nearly quadrupled in just 5 years. Insane. So what was happening, which, it's happened in the US too, is that the real estate market became wildly inflated. So a square meter in Tokyo's luxury district was a few $100,000. And the Imperial Palace, which of course wouldn't go for sale, but was estimated to be worth as much as all of the real estate in California at the time. So huge bubble. And that bubble popped right along with the stock market bubble, which caused this huge drop. Now, back in the 1980s, everyone thought Japan was going to take over, which is basically what everyone thinks of China right now, right? So everyone was very worried and constantly talking about it. And the crescendo was when Mitsubishi bought a 51% stake in Rockefeller Center in 1989. So around that time, the 1985 Plaza Accord was put into place. And that was an international agreement. It was between Germany, US, and Japan. And the idea was to control their currencies. So between the US and Japan, they wanted to push the dollar down and the yen up. That way they could fix America's trade deficits and Japan's trade surpluses. By the way, France and the UK were in this agreement too, but the main point was to fix trade imbalances. But that accord that Japan signed really screwed up their export-led growth. So to fix it, the central bank decided, hey, let's pump out more money. That way we can encourage domestic consumption and investment, because that's how it works, right? Give people more money and they're going to do more things with it. And sure enough, what did it do? Like it always does, it created an asset bubble. And that's what kicked off this massive run in the stock market. So equity prices took off and Japan just continued to outperform the rest of the world. And it was just euphoria, people buying hand over fist. PE ratios were out of control. In Peter Lynch's famous book that was published in 1990, he said the Japanese have their own way of thinking about stocks, and I don't understand it yet. Every time I go over there to study the situation, I conclude that all the stocks are grossly overpriced, but they keep going higher anyway. And yeah, Peter, maybe you're being sarcastic, but that's what a bubble is. That's sentiment. That's what drives markets. Duh, Peter Lynch. No, Peter Lynch is really smart. I'm sure he's just being sarcastic here. So the Bank of Japan, their Federal Reserve basically, got worried because housing prices were soaring like crazy. So they started to lift interest rates because central banks are supposed to be able to control everything, right? So lifting the interest rates, as we discussed in the last Buffett video, what does it do? It should slow down the economy. And it did indeed put a brake on the mania fueled by all that easy money. And around the same time, there was trouble brewing in the world economy with Saddam invading Kuwait. And you guys remember Saddam, right? He's the guy who was hiding in a hole with the big beard. Yeah, that's how history remembers him. So once they lifted interest rates just a little bit, the crash started happening. And during the first slowdown, they thought, you know what, it'll be a mild recession and then the boom will continue. And property values, the real estate market did continue to rise for months after the stock market started turning lower. But by 92, both were falling drastically. And then when the central bank, who's supposed to have all the control in the world, tried to cut interest rates to reverse the banking crisis that was happening, because all these bad loans were piling up and bank stock holdings were getting decimated, even as they tried to cut those interest rates, nothing happened because just everything in Japan was just way too intertwined with each other. Financial institutions own large chunks of other companies, which once had helped a lot. That's what contributed to the huge stock market rise. All this incest. You had a father bank with its daughter company, or a son-like company with its mother bank or its aunt bank. And everyone loved it because, incest turns on bankers and everyone on Pornhub. But at the end of the day, it is not a good thing. As they saw, because all the bank stability was tied to the volatile equity market. Everything was tied together, so it all fell together. Now, this is just the short story of how it happened, but you can see that there have been years and years of lost time. They call it like the lost decades. Well, I think it's just the lost decade, but you can see here that, it never stopped. And even now, since they had a huge run since 2012, it's still not even close to where the highs were before. And there has been a ton of manipulation from the central banks during all of this. Back when I was writing more macro stuff a few years ago, I was talking about Kuroda all the time. He was the Jay Powell over there. They had some three-arrowed approach that didn't actually work. They just had all these different plans. Central bankers, they're supposed to be able to control everything. Nope, couldn't prop up the markets. Look where they still are, still so low compared to where they once were. So of course, there have been so many studies on what happened in Japan and what we should learn from it. So in 2009, 200 economists signed an ad in the New York Times stating that more government spending did not solve Japan's lost decade in the 1990s. As such, it's a triumph of hope over experience to believe that more government spending will help the US today. And this article, by the way, is from 2009. So they're in the middle of a crisis. But the gist is the same. You can't solve an economic crisis by just lathering it over with money. At least that's one opinion. And clearly we're not doing much else different today with the amount of stimulus, record stimulus going into the market. So another report criticized the Japanese government's loose monetary policy and massive public work spending. It said this short-term static view attempted to prevent the economy from experiencing any negative effects from the correction, but it only prevented Japan from rolling out of its own asset bubble downturn and made the crisis worse. And it just turns everything into a zombie business economy. And here's the thing, they said this back in 2009, they're gonna say it today. But when it comes down to politics, which is what all this is, even the Federal Reserve, it's all politics, who is gonna say no to stimulus? No one wants everything to fall apart during their term. They don't want to be remembered in history like that. So no politician is ever gonna stop and say, you know what, during my term, I think we should take our lumps. Let's hit this bad recession now so that we're better off for the future. No, that's not how it works because that politician won't be there in the future. Everyone thinks short term. And I said before, that's what moves markets because yeah, that's how you get bubbles. That's how you get booms and busts. Now, some people disagreed. They thought the opposite. They thought Japan should have done more. The government intervention should have been larger. So these guys thought the Japanese policymakers were too concerned about limiting their deficit spending in the 1990s. These same people thought FDR made a similar error in the late 1930s by not expanding the New Deal. Now, these guys love free money because the New Deal was enormous. And others thought along the same lines that the government just didn't act fast enough. So after the bubble burst, Japan's powerful bureaucrats who had earned a reputation for brilliance in the 1980s, they dithered around for years. In the face of slumping demand and price deflation, they cut interest rates too slowly. They delayed a fiscal stimulus and failed to restructure the zombie banks, whose bad loans made them dead in all but name. So there's a lot of different opinions, but it all comes down to the fact that the central bank can't manipulate the market fully. You can manipulate it for a while, but eventually whatever is happening in the economy is going to be reflected in the stock market. But again, though, we are all such short-term thinkers, myself included, which was I got to talk about this stuff so I remind myself. But when the market was crashing here with with the CCPV and everything, you know, everyone thought it was the end of the world. Then all of a sudden it rebounds and everyone's thinking, hey, the market will never crash again. No one even remembers what happened here. And I know we got Powell, everything's good. We got a money printer. But then it just takes a few down days to remember, you know what? The markets did used to go down. And this is what? Only a few months. It's hilarious how our brains work. Another thing this reminds me of though is what Buffett said. And we covered this in a previous video where he said always bet on America going higher. And that's basically where a lot of Buffett's money came from. He bought companies and held them, and America continued to perform, meaning the companies within it performed and things worked out. But unfortunately, it won't always be like that. I hope it is, but probably not. And you always got to look at examples of Japan just to keep you honest. So think about in the US, you can buy and hold and expect what, an 8 to 10% return per year on average? That's what we're all told, right? But what if our market turns into something like this, where we don't just have a bad down year, we have multiple decades of terrible returns and it keeps going lower and lower? What if you bought up here in the 80s? You would have never recouped your investment. It would just go lower and lower. So this is why people rail against buy and hold, because it doesn't always work. The market can get really bad. And I mean, it's not just Japan. This has already happened in the US too. Look at the 70s right here. The market barely went anywhere for years. So if you were buying and holding during that time, what would you have done? This is a long period of time. So a really good thing about this Robinhood wave and all these people flooding into the market is that it is breaking that passive bubble a little bit. People might be realizing that, hey, I could get better returns by picking my own stocks instead of buying this ETF. Now that's good, but it could backfire if you don't think about the other side too. By saying, hey, instead of just buying and holding this ETF, I could invest in individual stocks and control my risk even better. I can control my downside versus if I buy and hold and then, you know, I'm just at the whim of the market. So the best thing to do is to stay humble and understand that anything could happen in the market. Instead of thinking, oh yeah, the market will never go down again because the Federal Reserve has our back. No, you still got to be careful and you still got to assume that you don't know everything. Really, you got to assume that you know very little. That's what I do. But I'm also fine with not knowing everything because I know I have my strategy in place, which has something very important, and that's risk control. So whatever crazy stuff happens, I know I can still be safe because my strategy plans for that to happen. Risk control is really the most important stuff, not just picking the right stocks and making a bunch of money, it's protecting your money. And that goes back to old Buffett, who knows it very well. What did he say? Rule number 1 in investing is never lose money, and rule number 2 is never forget rule number 1. But anyway, if you want help putting together that full strategy with the risk control in place, more than just picking the stocks, even though this will teach you how to pick those stocks too, definitely check out the free training that I mentioned before. There's a link in this video and down below in the description and comments. Worth checking out because you'll learn a lot. Shows you my strategy and the strategy that most of us at Fallible use. Now, like I said, I got that Ameritrade commercial for you. Check it out.
Daddy, Stuart's here.
Morning. Little freak.
Mom, Dad, this is Stuart. Oh, so you're Stuart. Oh, Dad, you guys have so much in common.
Okay, Stuart. So, what are your plans for the future?
Well, I wouldn't mind living here.
Yeah. No, what's your passion, Stuart?
I like to trade online.
Oh, online trading. It's only a fad.
You ever heard of Ameritrade?
I'm a stockbroker, son.
Dad, he only pays $8 a trade.
You know, you give a kid a computer and he thinks he can beat the market.
Oh,
I don't
dear.
want to beat the market. I want to grab it, sock it in the gut a couple times, turn it upside down, hold it by the pants, shake them out till all those pockets empty, all that spare change you've been grabbing from me. Let's eat.
I want to have his baby.
Call toll-free 1-888-495-8500. Ameritrade. Believe in yourself.
Well, what do you think about utilities?
Carol?
Fantastic commercial, right? And this is back when online trading was relatively new. You could get $8 commissions versus a full service broker you had to call on the phone. And it's the classic thing. The old guy, the old broker is hating on the young guy. And the same thing is happening now with Robinhood. And the same thing will happen in another 20 years when something new comes along. It's just history repeating itself over and over because human psychology never changes. So you could see it in the markets with central banks and what they've done before. And you could see it in Robinhood right now. But it's always funny just how similar the cycles are. But anyway, if you like this video, hit that like button, comment down below with your thoughts on this whole thing, and of course subscribe so I can see you in the next video. Stay fallible out there. Bye.